Hey, what's up, everybody? It is Wednesday, October 6th. So, it looks like we have a temporary agreement on the debt ceiling. And I'm going to be honest with you, I don't really understand it, but what happened today was Mitch McConnell, Senate Minority Leader, offered two proposals or two paths for the Democrats to raise the debt ceiling. And basically, I think the path that the Democrats are going to take is a short-term increase in the debt ceiling that will be in effect through December 3rd. Now, that's also when the current continuing resolution expires. So that aligns. And frankly, like I said, I don't really understand the proposals. I mean, in one case, it was about, the short-term increase that Democrats needed to state an amount, the new amount of the debt ceiling, or maybe they don't have to state the amount. It's not a suspension. Another path was not doing it through reconciliation, or McConnell saying they have to do it through reconciliation. I don't know. It all seems so convoluted. I mean, there's got to be an easier way to govern. I mean, it's crazy. I read it maybe a dozen times at different websites, Politico, The Hill, CNN, you name it. I tried to understand what was being offered and what was being accepted. All I know is that I think there's going to be a temporary increase in the debt ceiling through sometime in December. I think that date is December 3rd. Anyway, the market was down. That news came out. You get a rally. That's a headline reaction, typical of many headline reactions when something happens, when there's this big expectation of something, and then suddenly, the outlook changes because somebody says something or there's a new development. The stock market recovered its losses. We ended up. I do not trust this rally, and I'll tell you why. Because, again, I mean, it's great that we avoided default for the next couple of months. And by the way, we're going to be back in this situation on December 3rd, or coming up to December 3rd. This is a temporary fix if it goes through at all. I mean, they still have to vote on it. I think they're hashing out the legislative language, that would be based on what this proposal or what this agreement is. But we're going to go through this again December 3rd, or leading up to December 3rd. So it's just kicking the can down the road. It's a bunch of ridiculousness, but I digress. I don't want to get off track on what I'm talking about here. Anyway, for me, what I was going to say is, it's great that we avoid default. We still, I think, as a nation, look like a clown show with this ridiculous debt ceiling. I mean, they have to get rid of it. But again, getting back to my main point here, I remain focused on the fiscal flows. Now, for the first 2 days of this week, Monday and Tuesday, we had a 16.8 billion flow. We had an 18 billion flow. So it's like a 17 point something average flow. That is low, okay? That is less than half of what we were getting in August. Now, it's going to pop up a little bit because, we had 2 days here. You didn't have Social Security payments. You didn't have some of the big monthly payments that come along. I'm not counting October 1st, which was the first day of the fiscal year, because the first day of the month is always a big spending month, because you have Medicare, Medicaid, military pay, veterans benefits, disability, all that stuff on the first of the month. So I'm leaving that out. I'm looking at the daily flows, the average daily flows of a normal day, okay? So you had 16.8, you had 18. I mean, that is low. That is really low. So it's going to pop up a little bit, but I mean, it looks like we're going to end up in around that 20 billion, maybe slightly higher, 20 billion a day flow. That puts us right back around the pre-pandemic fiscal climate or fiscal situation that we had going on. I mean, there you're talking about, you know, a 3% growth rate, maybe a 3.5% growth rate. But any reduction from that 20, 22 billion, 24 billion average flow, I mean, we're talking about, you know, anywhere, we could be talking about a 2% or less growth rate. And I do not think right now the stock market reflects that. I mean, I just do not. I'm not even sure it reflects a 3.5% growth rate. Maybe it does. But as I've said in the past, I mean, these things, whether it's on the downside, whether it's on the upside, tend to overshoot. And I don't see right now that we have overshot. I mean, we have sentiment levels that are bearish, okay? They're not anywhere near extreme levels of bearish sentiment. And I think we're going to have to see that. We had 3 weeks. If you look at the AAII weekly survey, and we'll get another number tonight, I'll have that tomorrow. But I mean, the bull-bear spread, you take the bullish minus the bearish, I mean, that's only been negative for the last 3 weeks. And it was positive for like 37 weeks straight. So we'll see what happens. But I mean, the flows right now, they look a little skimpy to me. I mean, they look skimpy. I gotta say that. Today we had the EIA, Energy Information Administration's weekly report, the petroleum outlook. And, okay, so we had another build in crude. Crude was up about 3.5 million barrels. We had a build in gasoline, and we had a modest little draw in distillate. It was the second weekly build in crude. It was the third or fourth, I think, weekly build in gasoline. Crude's at a 5-week high in terms of inventories. Gasoline's at a 5-week high in terms of inventories. Demand was pretty decent. I mean, we had a small pickup in demand in gasoline. We had a pretty substantial pickup in demand in distillate. Jet fuel demand was up. Refiner inputs of crude, that was up. So demand was decent. However, exports, crude exports were weak. I mean, they dropped almost 1 million barrels a day in the latest week, down to like 2.1 million. That's slow, man. And product exports were up, but they're still kind of sluggish. I mean, they came down from peaks, you know, around April, again, kind of coinciding with when we started to see the deceleration in the fiscal flows. Net imports, like when you take imports minus exports or exports minus imports, that popped up pretty sharply. So net imports are up. Overall, I would say the EIA report was leaning more towards a bearish side. We did see a pullback in oil prices today. I sent out, you know, an email as soon as that petroleum status report came out saying, you know, this is looking bearish. We had a pullback in oil. Again, I mean, we're seeing a lot going on in Europe in terms of the spike in natural gas prices, the implied level of oil prices based on natural gas in Europe, but we're kind of not seeing that reaction. We're seeing it somewhat in prices here, nowhere near what the implied level is, because, you know, I don't know if I mentioned this, but I think, I mean, I read some reports where the implied level for crude based on where European natural gas is right now is $250 a barrel. I mean, that just seems crazy. But again, we're seeing inventory builds at a time when, you know, everybody's talking about shortages, and we're seeing weak exports when you would think, you know, maybe some of the product here would be going overseas because they need it, but that's just not happening. So keep an eye on that. Anyway, it looks like the debt ceiling situation is resolved, at least for a couple of months. We're going to be right back into this mess again come, you know, late November. A clown show. What can I tell you, man? It's a clown show. But I wouldn't rule out like a bounce in the market here off of this news, because that's what everybody's going to be focused on. But the real thing to pay attention to is that underlying fiscal flow. And I mean, like I said before, it's slowing down. There's no question about it. If I see that pick up substantially, then yeah, we could be off to the races again. But right now, it just doesn't look that way. Anyway, that's it. Oh yeah, my new podcast episode is out. Please check it out. The link is in the description right here below. And don't forget to like this video and subscribe. Thanks a lot. See you tomorrow. Bye.